Imagine you are standing in a grocery store, somewhere between the cereal aisle and the frozen foods section, and you have exactly $43 in your checking account until Friday. You do not pick up the larger bag of rice, even though the math clearly shows it is cheaper per ounce, because you cannot afford to spend $18 on one item right now. So you buy the smaller bag, the one that costs more per serving, the one that will run out sooner, and you will be back here again next week doing the exact same calculation. This is not a failure of intelligence or discipline. This is the poverty premium in action, and it operates as a kind of invisible tax that most economic conversations never fully account for. The core concept here is both simple and deeply uncomfortable. In most modern economies, the less money you have, the more you pay for the same goods, services, and financial products that wealthier people access at lower rates. This is not a coincidence or an accident of market forces. It is a structural feature of how pricing, credit, and financial infrastructure have been built over decades. And once you understand its mathematics, the way you interpret financial struggle changes entirely. To understand why this happens, you have to start with something behavioral economists call scarcity mindset. When researchers Sendil Mullainathan and Eldar Shafir studied financial decision-making across income levels, they found that the psychological weight of having too little money functions similarly to a cognitive tax. The mental bandwidth consumed by managing a tight budget, by calculating whether a purchase will overdraft an account, by choosing between two essential expenses when you can only cover one, measurably reduces a person's capacity for long-term planning and abstract problem-solving. This is not a character flaw. It is a neurological response to resource scarcity that humans share across cultures and geographies. The mind narrows its focus to the immediate crisis, and longer-term optimization becomes genuinely harder to execute, not because the person is less capable, but because the cognitive load of poverty is itself exhausting. Now layer the mathematics on top of that psychological reality. Consider how financial products are priced at different income levels. A person with a strong credit score and a healthy savings account can access a personal loan at somewhere between 6 and 10% annual interest. A person with a thin credit file or a history of financial instability might be offered a payday loan instead, which can carry an effective annual percentage rate of 300 to 400% when fees are annualized. Both people are borrowing $200 to cover a gap between paychecks, but the structural cost of that borrowing is categorically different. The wealthier borrower builds credit history and pays a modest fee. The lower-income borrower often enters a cycle where the repayment of the loan creates the very shortfall that necessitates the next loan. The same asymmetry appears in housing. A person who can afford a down payment accesses a 30-year fixed mortgage and begins building equity from the first payment. A person who cannot afford that down payment rents, which in most markets means paying a monthly amount equal to or greater than a mortgage payment, while building zero ownership stake in the asset. Over 20 years, the homeowner has converted hundreds of thousands of dollars of payments into an appreciating asset. The renter has converted the same magnitude of payments into a landlord's balance sheet. The monthly cash outlay is comparable. The long-term wealth outcome is not. Transportation follows an identical logic. Someone with savings and good credit buys a reliable used vehicle outright or finances it at low interest, and their transportation cost stabilizes. Someone without that cushion buys the cheapest car available, which statistically requires more maintenance, breaks down more frequently, and may eventually cost more in repairs than the vehicle is worth, all while potentially causing job instability if it fails on a workday. Or they rely on public transit in a city where transit infrastructure does not reach their workplace efficiently, adding hours to their week and limiting the employment options they can realistically pursue. Even basic banking carries a cost structure that penalizes low balances. Overdraft fees, which average around $35 per transaction, fall almost exclusively on accounts that hover near zero. A single miscalculated automatic payment can trigger a cascade of fees that push an account further negative, which then triggers more fees. Research from the Consumer Financial Protection Bureau found that heavy overdraft users, defined as people who overdraft more than 10 times per year, paid an average of $380 annually in overdraft fees alone. That is money paid not for a product or a service, but for the structural condition of not having a buffer. What this creates, when you zoom out and look at the system as a whole, is a wealth floor problem. Below a certain threshold, every financial system you interact with extracts more from you than it gives back. Above that threshold, the same systems begin working in your favor, compounding interest in your direction, offering lower rates because you represent lower risk, rewarding your stability with more stability. The threshold itself is not a fixed number. It shifts by city and by country and by family structure. But the dynamic is consistent. There is a level of financial cushion beneath which the cost of living measurably increases and above which it measurably decreases. This is why the first $10,000 in savings is not just a number. It is a structural transition point. It is the difference between paying overdraft fees and not paying them, between having negotiating leverage and having none, between being able to wait for a better price and being forced to pay whatever is available right now. It does not solve everything, and it does not guarantee upward mobility, but it changes the financial terrain in ways that compound quietly over time. The closing reality of all this is not fatalistic. It is clarifying. Understanding the poverty premium means understanding that financial struggle is often not the result of individual failure, but of systemic friction that is mathematically measurable. It means that the advice to simply spend less and save more, while not wrong, is incomplete, without acknowledging that the system charges more for the condition of having less. And it means that the most powerful financial move available to someone near that threshold is often not a new investment strategy, but the patient, deliberate accumulation of a buffer large enough to exit the premium zone entirely, where the math finally begins to work with you rather than against you. If this kind of systems-level thinking about money is something you want more of, subscribing to this channel is genuinely the most useful thing you can do right now, because this is exactly the type of analysis we publish consistently, the kind that does not tell you what to buy or what to do, but shows you how the underlying mechanics actually work, so that your own decisions become clearer. There is another video on this channel that maps out exactly why the first $10,000 behaves so differently from every dollar after it. And if what you just watched connected with you, that one will too.